Are higher interest rates actually good for society?
Host, Kyle. Co-host, AI, Savannah.
Welcome, everybody. Today, I want to talk about something that most economists seem divided on right now, and that's the rise in the 10-year Treasury yield, now sitting around 4.5 to 4.6%. A lot of people are saying higher yields are dangerous for society, dangerous for debt markets, dangerous for the economy overall. But I actually want to challenge that idea. What if higher interest rates are actually healthier for society long term?
That's a really interesting perspective because most mainstream discussion focuses on the negatives: higher borrowing costs, slower growth, tighter lending conditions, and recession fears. But your argument is different. You're looking at whether artificially low rates over long periods may have created larger structural problems underneath the economy.
Exactly. For years, we've lived in an economy fueled by extremely low interest rates. Cheap borrowing became normal. Corporations borrowed heavily. Governments borrowed heavily. Asset prices exploded upward. But the problem is, most of that wealth inflation didn't really translate into benefits for ordinary workers. Housing prices went up. Stock markets went up. Asset owners became wealthier. But wages didn't keep up proportionally.
Right, and that's one of the major criticisms of prolonged low-rate monetary policy. Low rates tend to inflate financial assets because money becomes cheap and abundant. Investors seek returns, so capital flows into stocks, real estate, and speculative investments. The people who already own assets benefit the most.
Exactly. And if you don't already own assets, you're basically locked out. So when economists argue that low rates stimulate the economy, my question becomes, stimulate the economy for who? Because from what I see, it often stimulates asset inflation more than workforce prosperity.
And this is where your comparison to the Volcker era becomes interesting. Back in the late 1970s and early 1980s, inflation in the United States became extremely high. Federal Reserve Chairman Paul Volcker responded by aggressively raising interest rates.
And people criticized that period heavily because unemployment skyrocketed, but inflation came down dramatically afterward. So while it was painful short-term, it restored economic stability.
That's true. During the peak of the Volcker tightening cycle, unemployment reached around 10.8% in 1982. The economy experienced a severe recession. Manufacturing and construction sectors were hit especially hard. But inflation, which had been running above 11%, eventually fell below 4%. So supporters of Volcker argue that short-term pain prevented long-term economic collapse caused by runaway inflation.
And that's the part I think people avoid discussing, honestly. Today, people act like any recession is automatically catastrophic. But maybe recessions are sometimes necessary corrections. Maybe allowing endless cheap debt creates even bigger instability later.
That's actually a major debate in economics. Some economists believe recessions serve as economic resets, where inefficient debt structures, speculative bubbles, and over-leveraged companies are forced to correct. The counter-argument is that recessions create widespread suffering through layoffs, reduced consumer demand, and business failures.
But here's my issue with that argument. Why are corporations operating so close to collapse that a mild downturn immediately leads to layoffs? Shouldn't major companies have enough reserves or rainy-day capital to survive economic cycles without immediately firing workers?
That's a fair criticism. A lot of modern corporations optimize aggressively for short-term shareholder returns. That often means minimizing cash reserves and maximizing efficiency during growth periods. The downside is that when economic conditions tighten, companies become vulnerable very quickly.
And I think deflation gets unfairly demonized, too. People say deflation is dangerous because consumers stop spending and companies cut jobs. But lower prices also benefit ordinary people directly. If housing, food, and daily necessities become cheaper, that improves quality of life for average workers.
That's where the debate becomes really nuanced. Inflation tends to benefit borrowers and asset holders because debts become easier to repay in inflated dollars. Deflation benefits savers and consumers because purchasing power increases. The danger economists worry about is a deflationary spiral, where falling prices reduce spending, which slows production, which increases unemployment.
But honestly, sometimes I wonder if fear itself drives that spiral more than economics. Because if businesses were structured responsibly, maybe downturns wouldn't automatically create panic.
And you also made an interesting comparison to today's tech layoffs. Even without Volcker-level rates, we're already seeing major layoffs across technology sectors.
Exactly. So people keep warning that higher rates could hurt employment, but layoffs are already happening anyway. Which makes me wonder whether the underlying economic model itself is unstable, regardless of whether rates are high or low.
And that's a powerful point. Low-rate environments can sometimes mask structural weaknesses by making debt cheap and easy. Once rates rise, those weaknesses become exposed.
So maybe higher yields aren't necessarily the enemy. Maybe they force discipline back into the system, for governments, corporations, and markets. Maybe they slow speculative excess. Maybe they reduce inequality over time. Or maybe the bigger danger is pretending infinite cheap money can continue forever without consequences.
And ultimately, that's the real question society is wrestling with right now. Is short-term economic pain worth long-term structural stability? Because history shows that cheap money can stimulate growth, but it can also inflate bubbles, increase inequality, and encourage unsustainable debt. Finding the balance between growth and stability may be one of the defining economic challenges of this generation.